Welcome back, investors, to a new episode of 36 Square Capital's Value Investor channel. Today we'll be looking at the consumer defensive sector and how those companies perform in a high inflation environment, which is basically what we are having in 2022. Also, we will be discussing through the 5 forces model of Michael Porter. Do those companies have pricing power? Is that reflected in their financials? And potentially, can they protect the profitability of their operations and, of course, through that, the interest of their shareholders? If you like the channel, do not forget to subscribe and hit the notification bell. Let's get started. Right, so remember, of course, that the content I'm sharing here is educational and there is no solicitation for you to buy or sell those companies. But nonetheless, I think it's interesting to have a look behind the financial reports and a consolidated perspective at the consumer defensive industry now that we are in Q3 earnings season and we are very early November 2022, so we can have a look at how did those companies perform. The principles that we are discussing here and methods are based on 2 trainings amongst the many trainings I'm giving. One is the Art of Value Investing, which is basically following the principles laid down by Benjamin Graham and Warren Buffett. We're going to be discussing economic modes as well later on in this session. And of course, we're going to be using the 5 forces model of Michael Porter. And this is being discussed in the Masterclass of Entrepreneurship and Strategic Management, which is also a university lecture I am giving. A small disclosure, in the companies that we are discussing, I want just to be very transparent, and I mean, you can look it up on my website on 36squarecapital.com. So the company has holdings in Unilever and Danone currently, which are one of the, I think, around 10 companies that we're going to be discussing today. And also we're going to be discussing Nestle and Kellogg's, and I was owning, or 36 Square Capital was owning Nestle up to 2021 and also Kellogg's until early 2022. So, but again, if you are interested in having those updates, you can go on my website and subscribe to any kind of, let's say, updates so that you know how the portfolio of 36 Square Capital is moving. Okay, so going into consumer defensive. So we're going to be discussing the following companies today. We're going to be discussing Unilever, Nestle, General Mills, Colgate, Palmolive, Kellogg's, Procter & Gamble, Mondelez, and Danone. I hope that some of those companies are known to you. And what we're interested in is looking at a high inflation environment. You see on the left-hand side, one of the latest graphs, how inflation is looking today, and you see that, I mean, during the summer and even now in autumn, inflation year over year is close to 10% in average in all developed countries. And you can see from the graph that this is a situation that did not happen since around 45 years. And let's be very fair, even myself, looking at very cheap companies because the market is still depressed. It was for me the first time, as I'm doing value investing for more than 20 years. But again, such a high inflationary environment only happened like 40 years ago. So it was also for me a learning curve and to try to understand what should be my behavior looking at the current level of inflation. And we're going to be discussing interest rates later on. So, but I think first things first, we need to look a little bit behind the overall inflation let's say statistic, and I want to give you a small update on macroeconomics. You know, I'm not the biggest fan of let's say macroeconomics, but I think it's nonetheless important to understand and then after to correlate with what is happening with our consumer defensive companies. So what I extracted here is the latest monetary policy report from the Federal Reserve in the US, and you have the source here to the Federal Reserve Gov website. But basically, I think what I wanted to extract is how does the Federal Reserve look at the current economic situation? And basically they say, and I'm quoting them here, is that the increase, so the current increase in terms of inflation, was driven by an acceleration of retail food and energy prices. And and I want to depict, so we're going to start first with retail food and then looking at energy prices. So is that really the case? Do other numbers confirming this? If we look at retail food, indeed, there has been a strong increase in the cost of grocery prices. And if you look at the last 12 months, basically we have had an increase of, in average, 10% compared to how it was over the last months or even a year ago. And so this is confirmed by let's say, the statistics. So there is indeed an increase of foods and beverages. And not only, so we have also commodities like wheat and corn, which have also seen a very high increase due, amongst others, to the Russian invasion of Ukraine. At the same time, and coming out of COVID as well, we still have very high fuel costs, bottlenecks in terms of supply chain. I mean, companies have difficulties. I mean, companies that are in the logistics industry do have sometimes problems to hire people, and there has been also a growth in high wages because of the lack of people available on the market. So all those elements are indeed driving up the cost of, let's say, grocery prices and in general food and beverages. So the second element is the increase in energy prices. And indeed, there has been a huge increase, around 30% this time, over the last 12 months in terms of energy prices. So it's going down again, but it's clear that oil prices have risen sharply, gas prices, natural gas prices as well. I mean, this is, of course, again linked to some extent to the Russian invasion of Ukraine, where Europe is trying to find ways no longer to buy Russian gas, but to procure it from somewhere else, if it is from the US or potentially from, let's say, the Middle East or Northern Africa. So there are indeed some challenges as well. And of course, this has created a lot of pressure on the prices of crude oil and commodities in general. So there has been definitely a high increase on that. And at the same time, and I don't want to extend too much the conversation about monetary policy by the Federal Reserve, but nonetheless, I mean, there is something that is very clear, is that amongst the various tools of monetary policy that the Federal Reserve or even the European Central Bank has, you can clearly see that compared to how the interest rates were a year ago, 2 years ago, during COVID time, I mean, even interest rates were at a certain time negative. We clearly have seen, if it is Federal Reserve or European central banks, being very strict and tightening the monetary policy related to interest rates. And we are seeing now, if you look at the 10-year Treasury rate, we are having levels that are very close to 4%. So we clearly see that lending money has become much more expensive. So it's definitely something that, and there are a lot of conversations, will this create a deflationary environment or recession? But what is clear is that money is no longer so cheap as it was compared to 1-2 years ago. And that's really the intention of the central banks, if there's a Federal Reserve for the US dollar or the European Central Bank for the euro, is that they are tightening the, let's say, the supply of money by raising the interest rate. So we have, and this is typical for an inflationary environment, because remember that central banks try to keep the inflation at around 2%. So that's definitely something that is part, let's say, of the fundamentals in terms of macroeconomic metrics that have to be taken into account as well. And when we look at the supply of money, and I'm always saying it's not just inflation linked to the Ukraine versus Russia crisis or the constraints in terms of supply chain. I believe there is also another effect, which is now, I would say, more or less 2 years old, is that there has been a huge amount of money that has been printed by central banks during COVID period. And with that, and you see it when you look at the Federal Reserve liability, so at the liability side of their balance sheet, there has been a big increase in 2020 up to 2022. So the balance sheet of the Federal Reserve, as an example, has increased from 4 trillion US dollars to around 9 trillion now. So that's more than twice the amount of liabilities that the Federal Reserve carries. You see now, starting mid of 2022, that they are starting to decrease the balance sheet. So that's typically something that happens when the Federal Reserve is tightening the monetary policy. So they are selling off their assets that they have, and by that they are increasing interest rates and lowering the value of the assets. So that's typically let's say, a constrained environment that they are producing. But we'll see how much they will tighten this, and also how much independency they carry versus also now politicians that are telling central banks and Federal Reserve that they should not be too much, let's say, strict on monetary policy. So we'll see. But I mean, nonetheless, just being very factual here, the balance sheet of the Federal Reserve has increased from 4 trillion to above 9 trillion over the last 2 years. So it means that, and again, you can correlate this with interest rates, that interest rates were very, very low. Now they are starting to sell off the assets, and through that the interest rates are going up. So that's the first thing. I think you need to first have a good perspective on the macroeconomic environment we're in. So high inflation, still challenges on the supply chain, commodities are very high, so oil prices are very high, wheat and corn are very high, linked to the Russia versus Ukraine crisis. Problems hiring people, so through that wages have to be increased to retain those people. And you see that there is high inflation, so the monetary policy of the central banks is really in the mindset of tightening the monetary policy, so selling off assets of the balance sheet, and through that reducing the balance sheet of those central banks. And through that we have what is happening today is that equity instruments, of course, have been devalued, and at the same time interest rates have gone up. So what we need to look now, as we have understood, I hope that you have understood the macroeconomic environment, is we will look now at those consumer defensive companies. So I mentioned it before, like the Unilever, Nestle, etc. So first of all, I mean, just a small recap, what are those consumer defensive companies? And there are a couple of categories of stocks that exist. So you have typically the growth stocks. Those are the kind of Spotify, Amazon, Alibaba. So there, in fact, the expectation of the market is really have very, very high growth beyond the average, let's say, GDP growth. So that's typically growth stocks. Facebook, so Meta, is part of the growth stocks. Google as well. Those are typical growth stocks. You have cyclical stocks. Those are stocks that are very performant as the economy goes, and then they are less performant when the economy does not perform so well. You have penny stocks. That's just a category of stocks where the price per share, which for me doesn't mean anything, is extremely low. So you have very high volatility in those stocks. You have blue chip stocks. That's typically my style of investing, where you have well-established companies with very large market capitalization. We're going to be discussing about brands and large brands. So typically you have also, those big brands that are part of the blue chip stock. And a blue chip stock can be at the same time a growth stock, but also you will find consumer defensive stocks that are part of the blue chip stocks, because those are very, very big companies in terms of market capitalization. Then you have income stocks, which also sometimes are blue chip stocks. So income stocks are companies that are pretty mature, and they typically provide a return to their shareholders through dividends, for example, or share buybacks. And we're going to be looking specifically here at defensive stocks, so consumer defensive stocks. So those are stocks that are basically less sensitive to market or macroeconomic conditions. And we're going to be, let's say, highlighting what are the reasons for that. And I'm going to be using the 5 forces model of Porter to really walk you through. So just to clarify, if you look, and I've put the URL here for those who are looking at the video and not just listening to the podcast. You can go on the finance.yahoo.com website and you make a screen on which companies are considered consumer defensive. You're going to have retailers in there. You're going to find food companies, beverages, household and personal products, packaging, or tobacco. those stocks, that's why they are called consumer defensive, those are very mature companies, and normally they provide consistency in terms of return to shareholders through dividends, and also the earnings are pretty stable, regardless of the state of the overall market environment, of the overall economy. And I mean, I don't like tobacco, to be very honest. I believe that retailers I consider them less consumer defensive, and that's a matter of appreciation, but I consider that food and household and personal products, and I will not discuss the Maslow pyramid here, but I consider that basic requirements like eating, so foods, safety, cleaning, so hygiene, those are things that, well, population needs this. And population will probably not let's say shower less, or just I mean, marginally speaking, versus, for example, buying luxury products, or let's say that kind of category. Even though very high wealthy people, they continue to buy luxury products even during macroeconomic downturns. But consider here that consumer defensive, those are products that people will continue to buy because they really need it in terms of basic requirements for their living, in fact. And I believe that food and household and personal products are clearly part of that category or subcategory of consumer defensive stocks. That's why I pick those companies that we have here, like the Unilever, Nestle, General Mills, etc. And I'm going to be sharing also the kind of strong brands that they have. And when we look at consumer defensive stocks, I just mentioned that typically consumer defensive stocks, they do provide consistent dividends and stable earnings, which means that very probably they carry an economic moat. And a moat is basically what? It's a, let's say, when you look at moats, is like you have this competition capabilities of attacking the company, and the wider the moat, the harder it is to attack the company castle. And this is what those companies, those consumer defensive companies, are all about. They have huge moats. And you have typically 5 attributes that define economic moats. Some are the advantages of low-cost production, for example. I mean, of course, for very, very high, let's say, volumes of production, you expect, and we expect those companies to have economies of scale. You have companies that have an economic moat that is linked to high switching costs. So people are not willing to change their shampoo, their water they drink, the food they buy, and they stick and they're willing to pay a premium price for those products. You may have network effects. That's more like, let's say, those social media platforms. Some intangible asset, that's more the brand thing, and efficient scale, that can be the Amazon. So Amazon has network effect, but also they have a very efficient scale on terms of logistics, which is something that Alibaba, for example, is looking into. And as we said, that consumer defensive stocks, they typically provide consistent dividends and consistent in terms of earnings. So the common characteristics of wide moat companies, and very often, not all the consumer defensive stocks, that's why I do not look at tobacco, but typically, let's say, foods industry and household and personal products, those are companies that carry high, or that have high switching costs. And the typical financial characteristics when you analyze the financials is that they have a high free cash flow to the firm, and they have a very high return on invested capital. They do have also consistency on the free cash flow and the return on invested capital. I mean, it's not the purpose of discussing it here, but just to make it simple on return on invested capital, something that I learned from Warren Buffett is like, typically, if you have a company that, for example, for the last 10 years was able to produce a return on invested capital consistently above 6 to 8 to 10%, there are probably very high chances that the company is carrying or has a wide economic moat. So that's the kind of thing that we, as investors, we would like to have. Companies that, even if the market is depressed, even if the economy is depressed, that our investments are protected and that we continue to get a consistent return to shareholders from those companies and from the management of those companies. That's what we are expecting. And we need, of course, in that context, to analyze as well the five forces model of Porter. Because, I mean, if I'm just said now that typically consumer defensive stocks, specifically foods, household and personal products, they have high switching costs. Well, we need to bring in the five forces model. We cannot just look at it from the financial perspective, but we need to understand, and this is what I'm teaching in the masterclass of entrepreneurship and strategic management, amongst others, when we discuss the strategic management part of a company, is like, what are the forces that are driving, let's say, and that are influencing the companies? If we look at a Nestle, how is Nestle, let's say, acting, and what is the power that Nestle has as a buyer versus its suppliers? And what is the bargaining power of the suppliers versus Nestle? The other way around, how Nestle as a supplier can pass or not, does it have pricing power towards its buyers? Do buyers have bargaining power against Nestle? What is the threat of new entrants? Are there potential substitutes that could be disruptive to Nestle? And then, of course, the rivalry among existing consumer defensive stocks. So we're going to be discussing this. So let's start first with the suppliers. When you look at the bargaining power of suppliers, and we look at our companies that we are analyzing here, so the Nestle, Unilever, Procter & Gamble, they're in the middle. They are the buyers. So there are two attributes when we depict here the bargaining power of suppliers, let's say, against our companies that we're analyzing here. Our companies, they have a pretty concentrated bargaining power as buyers. And I'm going to give a concrete example so that it's understandable for you. Look at Nestle. Nestle with their brand Nespresso, I mean, they manufacture huge volumes of coffee. The same with Starbucks. We're not analyzing Starbucks here. So through that, Nestle versus a small coffee manufacturer somewhere in South America or Central America, for example, Nestle has a huge bargaining power as buyer, which means by that, because they can easily change the small local supplier and they can say, no, whatever the name is of the supplier, let's call the supplier Jorge. Well, if you are not willing to give me the right price, I'm going to go to your neighbor and purchase coffee, which is an undifferentiated product. So suppliers to Nestle do not have a lot of bargaining power. So there, the concentrated bargaining power as a buyer of Nestle is pretty strong because it's concentrated. So they can push the needle, so they can push, or they can keep the prices, the purchasing prices low, for example, on coffee beans, because they are so Nestle is one of the largest coffee buyers in the world, same with Starbucks. But in order to produce the end Nespresso product, Nestle not only needs coffee beans, but the coffee beans have to be, let's say, shipped to the manufacturing plant. So there is this global supply chain that plays a role, and global supply chain, there is maritime traffic, air traffic, fuel costs, shipping costs, the cost of electricity, the cost of commodities as well. So there indeed, even though Nestle has strong bargaining power as a buyer against its suppliers, alone it cannot push the needle on buying fuel, for example, or reducing the cost of maritime traffic containers. So that's where indeed their bargaining power as a buyer is pretty diluted against global, let's say, maritime traffic suppliers, for example. So here we see it's like a two-edged sword. So they do have strong concentrated bargaining power as a buyer against their suppliers on, let's say, the primary goods, primary commodities like coffee beans, but on more general things that they need like transportation costs, they do not have bargaining power as a buyer. So there, the suppliers, they do have strong bargaining power against Nestle. The second thing is new entrants. I mean, we are looking here at we're discussing blue chip companies. A lot of those consumer defensive companies we are looking into are very, very big market capitalizations. And so they are all large cap, not mega cap, but large cap, so large market capitalizations. So the potential for new entrants is in fact very low. Why? Because new entrants would have high barriers to entry. The first one is, if you look at the distribution channels that all those consumer defensive companies have built up, that's an asset that those companies have, these distribution channels, and the agreement that they have with the retailers. In order to reproduce this, the cost is extremely high. At the same time, we're going to discuss it later on when we will be looking at buyers. When you look at those consumer defensive companies, they have brands that carry high brand loyalty by the buyers. So in order to reproduce, or when you're a new entrant and you want to gain the trust of and the brand loyalty compared to a Starbucks or Nespresso customer, you have to pull in a huge amount of capitals. That's pretty capital intensive. And then comes as well the regulatory and compliance environment. I just took here the example of the Federal and Drug Administration in the US, their FSMA, so the Food Safety Modernization Act. So also if you want to sell, coffee, or you want to sell soups, or you want to sell pizzas, or ice cream, you will have to comply with those regulatory and compliance requirements, and that has a cost as well. So it's not so easy for new entrants, or for example in the shampoo industry as well. If you are selling a new shampoo, you need to go through a certain amount of certifications before being able to sell the shampoo to your end customers. So you see that there are high barriers to entry for new entrants. So there indeed the threat of new entrants is pretty low in my opinion. Then we have substitutes. So substitutes are products that are offered. I'm taking here examples like Nespresso. We're discussing about Nespresso, so that's part of the Nestle group. It's one of their big brands. So what is a substitute to Nespresso, which is coffee? Basically you have maybe chicory coffee, which is a healthier maybe alternative to coffee. Maybe matcha tea are those substitutes. Gillette, which is part of Procter & Gamble, so shaving. I'm using myself Gillette for shaving. We're not speaking about competitors here. We're not speaking about Wilkinson Swart here, or Brown, which is, by the way, also owned by Procter & Gamble. But we're really speaking about substitutes to Gillette. What is a substitute to shaving? It would be permanent laser beard shaping or removal. I'm not sure that everybody wants to go for that. What is the cost for that as well, and the potential health impact? What is a substitute to Swiffer? I don't remember if Swiffer is also Procter & Gamble or Unilever. Doesn't matter. We're going to see it later on. But there we are speaking about dust, and Swiffer is there to extract dust. They're, of course, competitors to Swiffer. Of course, yes. But here we're speaking potentially about Dyson air purifiers, which in fact do not allow dust to settle down in a flat, in a house, for example. Those are substitutes. And how do you need to look at those substitutes versus those existing products? I'm not sure that a buyer who is used to buying Nespresso would easily switch to chicory coffee or matcha tea. I'm not sure that a person, myself, I tested once Wilkinson Swart. I was really not happy about it, so I went back to Gillette. So I'm willing to, and I'm consciously paying a high price for Gillette shaving utility. I'm for sure not willing to substitute that by a permanent laser therapy. So that's a no-go. We use Swiffer at home. I don't want to buy, I'm not even sure how good those, for example, Dyson air purifiers are. Maybe it's just that I'm not knowledgeable about it. I would need to invest it. Or invest time to understand how those air purifiers work. So, and then again, there is a cost to it. I have seen that standard or average air purifiers, you are at a cost of $300 to $500 versus a Swiffer, which is a marginal cost. So if I just think for yourself, when you look at those commodity products, coffee, shaving, Swiffers, would you really go for substitutes? For the same, so for going for equally good alternatives that would be even increasing the utility. If you look at permanent laser beard, it means that you no longer need to shave. Well, that's an increase in utility, but I'm not sure I want to do that. So I believe that all those companies that we're discussing here, we're speaking about consumer defensive food and home household products, that substitutes as well. They do exist, but as there is so much brand loyalty and the utility increase is not so obvious and sometimes it carries supplemental risk, I do not believe that there is a high threat of substitute products or services against the existing, let's say, consumer defensive stocks. And then we come to a very important one, which is the bargaining power of buyers. So when you analyze this in the 5 forces model, you need to think, what are the major factors that you need to consider to determine if there is bargaining power of buyers? Well, the first thing is there a high number of buyers versus suppliers? And if the number of buyers is small, it means that there is a high concentration of buyers, and through that buyers have high bargaining power against the suppliers. Remember, Nestle is also acting as a customer to the coffee bean manufacturers. If they have not bought, if they have not integrated, we're going to be discussing this in point number 4, if they have not integrated and they do not have their own coffee bean supply chain or that they own, but if they have outsourced this, they buy from those coffee bean manufacturers, and there they have a very concentrated power. There are not a lot of people. You are not buying coffee beans directly, or it's just marginal if you would do it. You're going to buy the end product or semi-finished product. You're going to buy an espresso coffee capsule, for example. So when you go to Starbucks, you don't buy the coffee beans. The coffee beans are there. You're buying the end product, which is transformed with some, I don't know, with some milk in it and some flavors like cinnamon, for example. So when you look at our consumer defensive companies, and I've picked here a couple of brands, Nespresso, so coffee capsules, Gillette, shaving, Evian, which is owned by Danone, which is water, Pampers, those are diapers for babies, Magnum ice creams, Magnum is owned by Unilever. Do buyers have bargaining power against those companies on those products? The answer is no. And the very easy answer and reason is that we are in a B2C space. So the amount of buyers is extremely diluted because it's consumer buyers. So there is not a high concentration of buyers. So with that, buyers do not have a strong bargaining power against their suppliers. And the suppliers are here 5 examples: Nestle, Procter & Gamble, Danone, Unilever. Is there a strong dependency that buyers have on a particular supplier? So can the buyer, the consumer, easily get the same similar product service from other suppliers? Well, yes, there indeed alternative exists. But, and here we come now to the third point, switching costs. Those companies have created very high brand loyalty. By the way, it's a pure coincidence, but I think it's tomorrow. Tomorrow we're going to be November 3rd, if I'm not mistaken. And yes, tomorrow it's November 3rd. You know that as a value investor, I do look at strong brands. And I like to buy companies that not only are consumer defensive, but also that they have strong pricing power, because customers are not willing to switch from a product which carries some intrinsic utility, value, and there is brand loyalty associated to it, and those consumers are not willing to change. And this is where switching costs or pricing power play a very important role. So switching costs are present when a customer's cost of switching to a new supplier exceeds the value that they would enjoy from making the switch. So basically, and ask yourself, talk to your family, ask your husband, your wife, your kids, what are their favorite products, their brands, and if you would give them an alternative, even a cheaper alternative, would they be willing to switch? If the answer is no, that's exactly where switching costs are present, and through that there is pricing power. So the buyers are willing to pay a premium, so are willing to pay more versus a cheap alternative. And this happens very often when there is brand loyalty and customers are willing to pay this premium. I mean, the Starbucks experience, I mean, let's be very fair, Starbucks is pretty expensive. You could have an alternative which is cheaper, but it's not a Starbucks coffee. And you don't have the cup of, let's say, the cup of coffee with your name on it. So there's a tribe effect also from a marketing perspective. So that's the kind of thing where switching costs and pricing power are important also to understand if buyers have bargaining power against their suppliers. Then there is backward integration. I was mentioning Nestle. Nestle, if you analyze a little bit deeper, Nestle specifically on Nespresso, on the coffee beans thing, and I think also Starbucks, they have been buying, let's say acquiring, so they have their own coffee bean manufacturing supply chain or supply chain, production chain. The reason is that they no longer want to be fully outsourcing this. They consider this to be part of the core business, so they have integrated part of the supplier chain into their operations. And and this is not the case for B2C. B2C do not have the opportunity to integrate backwards a supplier. I mean, that doesn't work. B2C consumers don't have the capital for doing that. So keep this in mind when you look at the 5 forces model of Michael Porter, and specifically when we look at consumer defensive stocks. Then we have to look as well at rivalry amongst competitors. And there is something, when you look at all those companies, it's very interesting to see that in fact there is rivalry and friction, but in some subsegments of the products or the product categories that they're selling, well, they are pretty strong. And so basically it means that those companies, we're speaking about Mondelez, Nestle, Kellogg's, Danone, etc., they in fact are sometimes reviewing their product portfolio to have strong positions, strong market shares in one specific, let's say, category. And this is what I'm showing on the right hand side for those who are able to see the video, is I've extracted from the latest Mondelez International, let's say, earnings presentation, where you see that in terms of global biscuits, they are by far worldwide leaders with 17% worldwide market share, where the second one is Campbell's with like 3%, then Kellogg's with 2%, and Ferrero with less than 2%, and PepsiCo and even Nestle below 2%. So in fact, they have a very dominant market position, probably with higher economies of scale, with high barriers to entry because they have structured distribution channels and people know Mondelez International for the quality of the biscuits, for example. And so there, well, of course, they have to continue monitoring if there are changes in the portfolio of their competitors, but they do have some attributes where they are very strong in, for example, the global biscuit manufacturing industry. In the second graph on the bottom right, I'm again extracting from the latest Mondelez International quarterly earnings the market share on global chocolate manufacturers. And there we see that Mars, and I think that Mars actually is not even listed on the stock exchange, that Mars has around 12.5, 13% of worldwide market share as global chocolate manufacturer. And then already comes Mondelez as well with around 12%, and then Ferrero with 10, Nestle with 8, Hershey with around, let's say 7, Lindt with as well around 5. So you see that there, compared to the global biscuit manufacturing industry, we have a high concentration in the hands of Mondelez with around 17% as a global biscuit manufacturer, let's say global market share, while in the global chocolate manufacturer market share, there the global market share is pretty much still fragmented, with Mars 13%, Mondelez around 13%, Ferrero 12%, Nestle 8%, Hershey 6%, etc. So their competition is probably more fierce than in the global biscuit industry, which means that by that probably also return on invested capital and profitability will be good for Mondelez as a very big market share owner worldwide, versus in the global chocolate manufacturing industry, competition will be fierce, so will be higher, and by that probably profitability is lower than, for example, in the global biscuit manufacturing market. So all in all, when we summarize and we bring this together on the 5 forces, we and I mean, this is my appreciation. You can agree or disagree on this, but I believe that the bargaining power of suppliers is average. And remember, I was looking at two types of suppliers. I believe that on primary goods and services, it is low, but on, let's say, the needs in terms of logistics, in fact, there the bargaining power of suppliers is high. That's why I'm qualifying here that the bargaining power of suppliers is medium. So it's a mix between low and high. So low for primary goods and high for example, cost of logistics and supply chain. Threat of new entrants for me is close to none. For the, let's say, elements I was explaining, the bargaining power of buyers is very low because of the switching cost. It's B2C. The threat of substitutes is, in my opinion, very low. You just look back at the examples I was giving about Gillette versus permanent laser therapy for beard removal. And in terms of rivalry, yes, there is rivalry there. But nonetheless, and I was trying to show this to you through one example, which was global biscuit market or addressable market versus global chocolate. Global biscuit is, I mean, Mondelez has a very strong position, so probably earning high profits. On the global chocolate, it's tougher, so probably there's going to be high rivalry and through that lower profitability. But nonetheless, when you look at the brands, we're going to be discussing now brand per brand. I believe that they have they are very, let's say, market specific, and we're going to see this when we're going to be looking into the various brands or various product categories like water, ice cream, those kind of things. So let's do that now. Let's go into company per company. So we came from macroeconomic environment that you understand where we are coming from. Yes, there is inflation. Yes, the cost of goods has increased. We have now looked at the 5 forces model for this consumer defensive industry or sector. Where are the forces strong? Where are they weak? And how does that now reflect company by company? Let's look at the last quarter performance now. Let's start with Danone. I'm going to start with the European companies, if I'm not mistaken. So Danone has some very strong brands like Evian, water, Danone yogurts, Activia as well, Alpro, which is soya milk, Silk as well. And again, they have much more brands, but I've just extracted some of the most known brands, at least for Europe. And according to Morningstar, the economic moats, do they have a wide moat? Well, they do have one, but according to Morningstar, they consider it to be narrow. Market capitalization is $31 billion, so it's a large cap company. The revenue of the last 3 months is 7.3 billion euros. It's interesting to see that revenues have grown by 19%. The operating margin, we're going to be discussing this in conclusion, but European companies in the latest quarter have not updated their income statement. They only have provided a sales update. So we do not know if profitability has gone up. What we can see nonetheless, and I'm summarizing this in my very last conclusion slide, is we see that volumes for Danone, the volumes have been flat. They have not grown in terms of sales, in terms of volumes, but they have increased the pricing by 10%. There has not been a lot of merchant acquisitions, and foreign exchange has had a, let's say, positive effect. We're going to be discussing this in conclusion as well, that the euro versus US dollar parity has come down in the last quarter from a rough cut 1.06 to 0.99, so which explains this 7% foreign exchange impact, positive impact for them. What is interesting as well, and I've put the sources for those who can't see the slides, so I've really extracted the comment of each CEO for each company we're analyzing. And for example, Antoine de Saint-Affrique, which is the new CEO since more or less a year from Danone, has been stating, quote, "We continue to implement pricing actions in a responsible and disciplined manner." And we see this. They have been passing more than 10% the increase of, primary goods to the end consumer. So this is a signal that they do have pricing power, isn't it? Because, I mean, if you don't have pricing power and people are easily switching from your products to a cheaper alternative, you cannot just increase the prices by 10%. So that's already an interesting signal. Next one, Nestle. So Nestle has a very wide moat. I mean, in terms of market cap, currently it's around 300 billion US dollars. That's a very, very large market capitalization. They did not provide a 3 months perspective. They have provided a 9 months perspective. And so revenues have been growing indeed by 9% more or less. So over the last 9 months, so year to date, there have been the revenue they generated was around 70 billion Swiss francs. And they only made a statement that they're expecting the net income, so the profitability, to increase. When we analyze, and I've been looking into the financial reports, again, for those who see the slides, you have the URL here, but go on the Nestle website, look at the latest 9-month sales report. They provide details about volume, pricing, merger and acquisition, and foreign exchange, how that is impacting the revenue growth. So volume was only plus 1%. Pricing has been plus 7.5%. So again, we see pricing power here. Merger and acquisition, so the scope is not comparable to last year, Q3. So there has been an increase in scope of 1.20% through merger and acquisitions. And foreign exchange has been more or less flat. They did not have a big impact in terms of foreign exchange. So all in all, you see that the 9.22% year-over-year growth is basically driven by pricing mix increase. What is Mark Schneider, who's the CEO of Nestle, stating in the latest quarterly, let's say, sales update? It's not a full income update, but just a sales update. Quote, "We continue to adjust prices responsibly to reflect inflation. We aim to keep products affordable and accessible while considering the interests of all our stakeholders." I mean, just read between the lines. They are saying, of course, there is inflation, and we have higher cost of sales, very probably. We're going to see this in the conclusion slide. But at the very end of the day, while we try to keep the products affordable for our consumers, as we do have pricing power, we are passing the increase in cost of sales to our end users in order to protect the interests of our shareholders. This is what it means, amongst others, with all due respect. Next one, Unilever. Big brands, Ben & Jerry's and Magnum ice cream. We love Magnum at home. Axe, Rexona, you have Cif, for example, for home cleaning. Dove as well. I think those are shampoos or soaps. Knorr soups. Morningstar considers Unilever to have a wide economic mode. The market cap is around 114 billion US dollars, so half of Nestle, but still a very large market cap. The revenue over the last 3 months has been at 15.8 billion US dollars, so that's a 17.8% increase. And again, you see the split between volume, pricing, merger and acquisition, and foreign exchange. Foreign exchange has been positive for them. Pricing plus 12.5%. Volume minus 1.6%. So in fact, volumes have decreased, but still they were able to keep more or less the same sales volume while passing 12.5% of costs to the end consumer. What does Alan Jobe, and actually he's retiring I think next year from the CEO, or stepping down from his role of CEO of Unilever, quotes, underlying sales growth improved to 10.6%, led by further increases in pricing. So again, this is where consumer defensive stocks are strong. When there is inflation, they can pass inflation to the end consumer. Remember, when you look at the 5 forces model, that consumers do not have bargaining, so buyers do not have bargaining power against the suppliers. The suppliers are the companies we are discussing here. So we see again that, they have increased pricing by 12.5%. Colgate-Palmolive, big brands, Sanex, Colgate, Ajax, Tahiti, Palmolive, Suplene as well. So, and you see those are more, let's say, home or house cleaning products, or let's say personal, health products, which are different from ice creams, for example, of Unilever. So you see that the rivalry is not necessarily there. So Morningstar is considering that CP has a wide economic mode. Market capitalization is sitting currently at 62 billion US dollars. Revenue last 3 months was at 4.4 billion US dollars, plus 1% only. Net income, we are here in a US company that is reporting a 10K through 10K quarterly unaudited report. Net income has gone down by 11% and the year-over-year growth, so as I said, 1%. compared to the quarter 3 of last year, so 2021. When you look at the details, volumes have decreased by 4.5%. Pricing, so they were able to pass 11.5%, so increase the end price to the consumer. Merger and acquisition, there was none for CP, so that the scope of business has remained constant, and foreign exchange minus 6%. So we see here that a US company that is reporting in US dollars has probably been impacted by the change in parity between euro and US dollars, going from 1.06 to 1.098 currently. So quote of Noel Wallace, who's the CEO, so beyond revenue growth management and the significant pricing actions we are taking, you can read the rest of the quote in the 10K report. So again, the figures and the quote is clearly stating that, yeah, pricing has been increased because there is no bargaining power of the buyers because it's B2C segments. And so the companies, those companies have, again, CP again has pricing power and switching costs are existing. Consumers do not want, I mean, if you're used to buy Colgate in terms of brushing your teeth, you will not change. I promise you, you will not change. And again, ask your family, your friends around you, ask them what are the products that they use day in, day out, and how willing they would be or how resistant they would be to change versus would they be willing to continue paying a premium even if the prices would increase by 5%, 10%. General Mills, they have Old El Paso. I love the fajitas from Old El Paso. Yoplait yogurts, Green Giant, Cookie Crisp. Economic mode considered by Morningstar is narrow, so there is an economic mode. Market capitalization sits around $48 billion. Revenue latest 3 months is $4.7 billion, so plus 4% increase. Net income, interesting, plus 31% to $820 million, and the year-over-year growth 4.01%. So when you look at the details, you see that the pricing has increased by 15% and volumes have gone down by 5%. So, and merger and acquisitions as well, they have divested to minus 5%. The scope has become smaller, so probably there is a one-off effect also in the net income. Foreign exchange, they were not too much exposed to it, minus 1%. What does the CEO say, Jeff Harmoning? So there is a 10K report. We continue to deliver strong performance in a highly volatile operating environment, quote close. So he's not making too much statements on the pricing mix compared to other CEOs that we have been seeing now. Next company, Kellogg's, economic world considered by Morningstar, wide market cap sitting at 26 billion. I mean, I made a disclaimer. I bought, in fact, Kellogg's at around 56 or 57 US dollars a share and sold it at around 73 US dollars a share a couple of months ago. So the revenue last 3 months was at 3.8 billion, so plus 8.7%. The net income has gone down by 14% to 326 million. So there has been an impact. And so when you look at the price mix, and you see the quote of Amit Banati, the CFO, quote in the latest analyst call, he said, I think it's a man, I'm not sure, my apologies to the women, but I believe that Amit is a male person. Anyhow, the CFO was stating price mix remained elevated in quarter 2, even accelerating as all 4 regions utilize all levers of revenue growth management in order to complement productivity initiatives. So pricing has increased by 13.7%. And I mean, you probably know the Kellogg's big brands like Pringles, Cornflakes, Fruity Loops, those kind of things. So yeah, they have, I mean, volumes have gone down, but at the same time they have passed, again, cost of sales to, or an increase in cost of sales, so the inflation impact to the end consumer. Mondelez International, they just published yesterday evening after market closing their results. Were a little bit disappointing. So revenue last month has increased by 7.7 billion. Market cap is at 84 billion currently. Net income 532 million, minus 57%. But again, if you look at the details, yes, they have been very, let's say, strict at executing and being very effective in the execution of pricing. Pricing has increased by 11.4%, but they have been hit by foreign exchange minus 8.20% because, again, they have been exposed to the euro-US dollar change in parity over the last quarter, 1.06 to 0.98 and 0.99 lately. Procter & Gamble, also very big brands like Pampers, Gillette, Head and Shoulders, etc. Very wide economic mode, market cap sitting at 320 billion US dollars. Revenue last month has increased, or last quarter, sorry, by 1%. Net income has gone down by 4%. But again, they have, according to the CEO, they have delivered, quote, we delivered solid results in our first quarter in a very difficult cost and operating environment. So yeah, volumes have gone down, foreign exchange minus 6%. The scope of business, M&A, has remained constant, but pricing mix plus 10%. So they could save the profitability more or less by passing the cost to the end consumers. Voila, so I mean, let's stop here, but I think you understood that basically if I bring this together and we just take a step back and look at it from an helicopter view, we see that revenues overall, and I've calculated this, in average revenues year over year, so quarter to quarter comparison, quarter 2022 to the last, to the quarter we're comparing 2021, revenues have grown on average by 8.5%. That's true. But the story is different in terms of profitability. The reason for that, and I'm trying to bring this all together, this conclusion slide. So what I tried to put here is, in the 8 companies I tried to analyze, there are 3 European companies, Nestle, Unilever and Danone. Nestle, I just calculated a 3-month extrapolation because they only reported 9 months. So Unilever, Danone, as already said earlier, those companies, at least for the last quarter, only provide a sales update. They do not provide a full income or P&L update. They only do this every 6 months. US companies like Mondelez, Procter & Gamble, General Mills, Colgate, Palmolive and Kellogg's, they produce a full 10K report. So we have a look, we are able to see their cost of sales, we can see their profitability and the details of volume, pricing mix, M&A and foreign exchange. We have this for all companies. So what does the summary and wrapping up here tell us? First thing, so the growth in average has been, so the revenue growth has been in line with overall inflation, an average of 8.5%. Of course, it's a mixed bag if you look at Colgate, Palmolive or Procter & Gamble, where the growth is nearly flat. Overall revenue growth, we're going to look at the details later on. But growth is more or less following overall inflation. The second important thing, and I can only look at it for the companies that have provided a full income statement update, which are the US companies, so Mondelez, Procter & Gamble, General Mills, CP and Kellogg's. We see that the cost of sales have increased. So for each dollar of revenue that has increased by, in average, 8.5%, the cost of sales has in average increased by 9.7%. So we see that indeed they are impacted. So basically, if they would not be able to pass this increase in cost of sales to the buyers of their products, the profitability would go down. And this is basically what happens. Profitability went partially down. But, and I think this is the main summary, is that while volumes remained flat, so we have seen that sales volumes have remained flat and even declining in average by minus 1.8%. So that's bullet point number 3 here. We see that companies, all of the companies have increased the pricing in average by 11.5%, but US companies, their income has been negative. The reason for that is foreign exchange. So what is the lessons learned here is that we do see that those consumer defensive companies have pricing power. So the bargaining power of buyers is non-existing because high switching costs. So the companies can, in the increase of cost of sales that we see for the US companies that provided the 10K latest quarterly report, we see that there is an increase of cost of sales, which follows the macroeconomic, let's say, trends and metrics that we have seen. And volumes have remained flat. So US companies, in fact, have not benefited because the US dollar parity with the euro has changed. The euro versus US dollar parity went down from 1.06 to rough cut 0.99 over the last 3 months. That's basically where those companies that are operating on a global scale, including Europe, they are hit by the changes in foreign exchange. While European companies have the same effect very probably. I mean, I don't see the figures, or we do not see the figures because they only provide a sales update, but the growth has been there. But the pricing increase has only been as well around 10%, what we see also for US companies. But they have probably benefited from, let's say, the euro versus US dollar change in parity, and probably they were able to add around 6% of profitability because of these changes in euro versus US dollar. So at the very end of the day, the lessons learned is that, so yes, revenues have grown. Companies have priced, all those companies have pricing power. They were able to pass cost of sales increase to the end consumer because the end consumer doesn't have bargaining power as a buyer against his or her suppliers. But foreign exchange made a difference in, let's say, performance for the last quarter between European companies that benefited from this change in euro versus US dollar, going down from 1.06 to 0.99, where US companies that indeed are selling into European markets, amongst others, they have in fact not benefited from it because they're reporting in US dollars. So I think that's really the lessons learned, but it clearly shows that consumer defensive stocks do have the possibility to increase prices to the end consumer because there is brand loyalty, because there are high switching costs, because the utility, the perceived utility of the end consumers is definitely there. So I hope that by really looking into behind the figures, behind the annual reports and bringing this together in a consolidated way, that you were able to understand the mechanics and how to read the performance of those 8 very large market capitalizations in the consumer defensive stock or in the consumer defensive market of foods and household products. Hope it was useful. As always, you have my contact information, so you can follow me on LinkedIn, you can follow me, you can go directly to my website of 36capital.com, and also now, of course, if it is on the YouTube channel, do not forget to subscribe. And if you're listening to this podcast through Spotify, again, thanks also for listening in, and talk to you in the next update. And I have a couple of interesting topics that will be coming up. So thank you for your time. Take care.